measurement topic is concepts and computation of value at risk, calculating portfolio risk of more than one assets. Value at risk VAR concept meaning value at risk VAR is statistical measure that estimates the maximum expected loss on an investment or portfolio over a specified time period at a given confidence level under normal market conditions. Value at risk is a financial metric that estimates the risk of investment. More specifically, VR is the statistical techniques used to measure the amount of potential loss that could happen in an investment portfolio over a specified period of time. Value at risk gives a probability of losing more than a given amount in given portfolio. VR meanings already mentioned here, and their example is given. A one day VAR of 10 lakhs at a 95% confidence implies that there is only a 5% chance that losses will exceed 10 lakh in one day. Okay, means 5% chance that we have accepted. There is a diagram given. We will see that diagram in your notes. I will provide you that notes. Advantages of value at risk VR. First, easy to understand. Value at risk is a single number that indicates the extent of risk in a given portfolio. Value at risk is measured in either price units or as a percentage. This makes the interpretation and understanding of VR relatively simple. Second, applicability. Value at risk is applicable to all types of assets that are bonds, shares, derivatives, currency, etc. Thus, VR can be easily used by different banks and financial institutions to assess the profitability and risk of different investments and allocate risk based on VAR. Means you should have to become an expert in risk management. You have seen the movie Pushpa, how he take responsibility and risk to deliver that wooden to their clients. Sandalwoods, okay, Chandan, sandalwood to their clients. That sandalwood is really very of high level value. Red sandal, Rakta Chandan, which is also called as Rakta Chandan, which is always liked by God Ganesha. Universal. Third is universal. The value at risk figure is widely used, so it is accepted standard in buying, selling, or recommending assets. Limitation of value at risk. Large portfolio. Calculation of value at risk for a portfolio not only requires one to calculate the risk and return of which asset, but also the correlations between them. Thus, the greater the number of diversity of assets in a portfolio, the more difficult it is calculate. VAR. Second, difference in methods. Different approaches to calculating VR can lead to different results for the same portfolio. Third, assumptions. Calculation of VR requires one to make some assumptions and use them as inputs. If the assumptions are not valid, then neither is the VAR figure. Key elements of value at risk. First, specified amount of loss in value or percentage. Second, time period over which the risk is assessed. Third, confidence interval. Example VR assessment question. If we have again a 95% confidence interval, what is the maximum loss that can occur from this investment over a period of 1 month? This is the questions. Means we have only chances of 5%. Value creation through real options in management. A real option approach to management and strategic management, in particular, consider strategic decisions making as a process aimed at actively reducing exposition to downside risk and at promoting exposition to upside opportunities. The real option approach stands at the hinge between pure finance and softer areas of decision making. Under risk, such as project evaluations, market entry, and market exit, organizational restructuring and re-engineering technology adoption, etc. The approach represents a major shift in strategic management but remains relatively unknown in spite of its adoption by firms such as Airbus, GE, Hewlett Packard, means HP, the company of IT sector, hardware sector, which has different types of components. Intel, the chipset, Intel, and Toshiba and others. Few years ago, Toshiba also entered in the market of hardware. So we have seen the laptops of Toshiba also available in the market. Consider the problem of planning your vacation next summer. Your travel agent tells you that there are two types of vacation packages available at the destination of your choice. Okay, means you have also to come on industrial visit, which will be arranged by our college. Choice is that rigid and flexible. Okay, under the rigid package, you have to specify exactly the dates of your vacation. Under the flexible package, you can go for any 7 consecutive days between May 1st and September 30th. Okay, through time what's happened, we decided to go on vacations, but there are a big chaos of dates. Which date that we have to select to go on vacations? Okay, so maximum people takes the other option, that is flexible options, which means that we can give dates after our approval to the tour company. And what about the rigid choice? When you have decided a date and given to tour company, you will not change that date. You must have to go, either you have to go on that vacation on the same date, or you have to leave your payments to that tour company. Furthermore, the flexible packages is 80% refundable. Okay, 80% flexible packages are refundable and 20% rigid packages are not refundable. How much more would you pay for the flexible package? This is one of the innumerable questions that can be answered by real options. The main purpose of the risk options approach to management is to explicitly recognize and estimate the value of flexibility and to optimize decisions requiring giving up or creating flexibility. A real option approach to management and strategic management in particular considers strategic decisions making as a process aimed first at actively reducing exposition to downside risk and second at actively promoting exposition to upside opportunities. The real option approach to management stands at the hinge between pure finance and softer areas of decision making under risk, such as project evaluation, market entry, and market exit, organizational restructuring, and re-engineering technology adoption, etc. The approach underlines a frame of mind and uses methodologies that appeal to the wide array of managers, thus providing a common language. Real options have applications in many areas that are central to modern corporations, that are market coverage and development, finance, human resources management, technology management, R&D, and knowledge management, etc. The approach represents a major shift in strategic management but remains relatively unknown in spite of its adoption by firms such as Airbus, GE, Hewlett Packard, Intel, Toshiba, and others. Most of these are electrical companies or IT companies. Some quotes from the business press: real option analysis rewards flexibility, and that's what makes it better than today's standard decision making tool. Net present value, NPV calculations, the value of project by predicting its payouts, adjusting them for risk, and subtracting the investment outlay. But by boiling down all the possibilities for the future into a single scenario, NPV doesn't account for the ability of executives to react to new circumstances. For instance, spend a little upfront, see how things develop, then either cancel or go full speed ahead. Enron President and Chief Operating Officer Jeffrey K. Skilling credits real options thinking with helping Enron transform itself from a US natural gas pipeline company into a global wheeler dealer that trades commodities including gas, electricity, water, and most recently telecom bandwidth. When Enron company entered in India, there were so many quarrels between the politicians about to give entry Enron company in India or not, whether this company will help India to develop electricity or not. Real options akin to financial options but for non-financial or real assets are handy in limiting downside risk and capturing positive opportunities. Their effectiveness, however, is subject to a number of limitations. Many companies may not appreciate the options embedded in their investments. Others lack the capabilities to value real options and use them in allocating resources. International joint ventures supposedly enhance flexibility and reduce risk, while multinational networkers provide the enterprise with switching options. The real option approach emphasizes that many investments create important follow-on opportunities that a company may or may not subsequently exploit. Consequently, the real option approach highlights value that is contingent on earlier investment. For instance, while a given R&D investment may have a very low or even negative net present value (NPV), it may also provide platform for future favorable investments. Real options bear some other similarities to financial options. For example, the value of both types of options increases with uncertainty, further by providing managers discretion, rights but not obligations. Financial and real options can help companies limit their downside risk while also gaining access to upside opportunities in the future. However, unlike financial options, real options come into existence by the opportunities created by the company's strategic investments because their underlying assets do not trade in liquid markets. Real options also present unique valuation challenges. Exploit hidden assets and you will succeed. Neglect them and you will wind up with a collection of old nages. What kind of hidden assets do I mean? For example, the unexploited opportunities to add a new product line, expand overseas, or engage in e commerce are hidden assets that do not appear on a company's financial statement and have not yet contributed to its profit. I have suggested two courses to all the students that a first course is financial management for managers in NPTL and other is e-business which is related to e-commerce and this subject will really help you to create an entrepreneurship of your own. When you buy a company you often get these features for free. I call them real options, an analogy to the financial options traded in Chicago. There's a big difference, though financial options remain valuable when held by passive investors. But owning a business is not a passive exercise. The owner has a real job to do, providing governance, managing capital, and helping a business achieve its potential. Real option analysis is based on the observation first made more than 20 years ago. That's a company evaluating an existing assets or potential investment is in much the same position as the holder of a financial option, such as those written on stock or commodity prices. The holder of the financial put options on, say, the price of oil can exercise an option if the price rises above a pre-agreed level but doesn't have to if the price falls. Similarly, the owner of a marginally profitable oil field has the right to exploit if the price of oils rises, but is not obligated to do so if it doesn't. That observation leads to the assumption that the future value of such an investment can be best valued in a similar way to financial options rather than by simply discounting the cash flows expected from its future. In particular options, valuation takes into account the risk and rewards of future uncertainty or volatility, which traditional discounted cash flow DCF models do not. To evaluate potential projects, they almost invariably have to resort to a theory of corporate finance called the capital asset pricing model CAPM. Yet real life managers tends not to like this model for the simple reason that it ignores the value of real life managers. So they might welcome some recent academic work in the ivory tower. They are talking about ditching the CAPM for a rival called real option theory that places managers at its very core. More fundamentally, the flaw in the CAPM is that it implicitly assumes that when firms buy new assets, they hold this passively for the life of the project, but they do not. Instead, they employ managers precisely in order to react to event as they unfold. Obviously, this managerial flexibility must be worth something. Option on real assets and indeed pocket bets behave rather like options on financial assets, puts and calls on shares or currencies. Say the similarities are such that they can, at least in theory, be valued according to the same methodology. There is a snag, of course, sheer complexity. Pricing financial options is daunting, but valuing real options is harder still. Their term, unlike that of financial options, is usually open ended or undefinable. The volatility of the underlying asset can be difficult to measure or guess, especially since it is not always clear what it is if, for example, it is yet to be invented. How can one define the appropriate benchmark asset class in the case of a new drug for a rare disease? And there may be additional variable to consider, such as the strategic benefit of preempting a rival. As it clear from this course, the real option methodology is emerging as a potentially powerful tool for the executive. However, this potential will only be realized by decision makers who combine the real option state of minds with thorough technical skills and good information systems. The implementation of a real options approach could be very valuable, but at the same time is the challenging task. The link between real options and finance. As the direct outgrowth of finance, the real options approach uses techniques and methodologies which prevails in this field. However, finance is mostly preoccupied with evaluating and pricing financial instruments, put and call options among them, as the real option approach percolates into various areas of management and decision making. There is a shift of emphasis from pure evaluation to decision analysis and optimization. The origin of the real options approach can be tracked back to the remark by Stewart Myers that holding a real investment project like the construction of a plant was formally similar to holding a financial call options. A construction project involves the options but not the obligations to spend resources at some future time in order to obtain an asset and operating plant whose value is normally stochastic. The randomness of a financial options arises from the fact that the underlying asset is usually a stock, so that at the time the option is acquired, it is not clear whether the non-exercise price will be lower or higher than the still unknown stock price in the future. Thus, the option may never be exercised. Similarly, if the price of the projected plant's output does not evolve favorably, or if investigation reveals that appearing operating cost would be high, then it is not worth exercising the plant construction options. You may know about the Burj Khalifa, which is the topmost building in the world, situated in Dubai. And there are so many statues in India which have a higher and taller height, just like Unity, Statue of Unity in the Gujarat. Even when the Sri Ram Mandir temple is built up by the companies, construction companies, they have a lot of challenges because the surface of that land was totally of sanded, means sand basis, means the base of the temple must be on the hard land, but they have the challenge to set that temple on sand land. For that, they have used different types of technique which were used by our ancient temple construction experts. The distinction between option evaluation and decision making is only a matter of emphasis. In fact, evaluation requires solving the decision problem raised by the options. Should it be exercised and when? But the distinction is important. It underlines that good decision making creates value, as we argue further below. Applying the real option approach to decision making in organization creates value. This approach brings the discipline of finance into other areas of corporate, public, or individual activities. Now, dear students, you are also doing jobs, but your target should be to get the distinction marks in our MBA course. Now you have your last fourth semester, so you should have to take much more efforts because all the semesters are included to calculate your CGPM. So you should have to achieve minimum first class, and you must have to also achieve distinction in your company also. Another difference between financial options and real options arises from the nature of the uncertainty affecting the underlying asset. In the world of financial options, uncertainty is all about future stock prices. It is valuable due to the limited downside and unlimited upside fluctuations of the payoff, fluctuations that are linked to the exogenous outside the control of the manager, variability or volatility of the price of the underlying financial assets. In the world of real options, uncertainty has value because of the ability of executives to manage the uncertainty of projects. In a world without uncertainty, managers would not be needed. Means, where will be the need of manager? If uncertainty or risk is there, means you have to survive your company, or sustainable development should be there in your company with your own logics and ideas. Executive adds value to the firm because they actively manage change as uncertainty unfolds over time. The real options approach attempts to quantify that value, that is, the value of active managers of uncertainty by managers. This crucial difference in the nature of uncertainty has its counterpart in the nature of the information that needs to be used for option evaluation and management. For financial options, most of the time, long and frequent data series are available about stock prices. For a real option, such as the construction of a production plant, the uncertainty arises from future prices or production cost. For the vacation packages mentioned earlier, it is your time availability that is uncertain. While product price may have some similarity with stock prices, they are not usually recorded with the same accuracy, nor are they driven by the same factors. When it comes to cost evaluation or to a person's availability for vacation, both the form and the nature of the data available are fundamentally different. There are also differences in the institutional environment characterizing the option evaluating the decision making problem. An important one is that financial markets are often rich and dense enough that appropriate portfolios of existing traded assets can duplicate the risk associated with the asset underlying a particular options. It is under such circumstances that the celebrated Black-Scholes marathon approach is applicable. At morning session, we have already discussed about Black-Scholes marathon approach. In the case of many real options, this so-called spanning assumption cannot be invoked, so that other techniques such as stochastic dynamic programming must be used instead of the contingent claims approach prevalent in financial applications. Although widely used in finance, techniques such as scholastic dynamic optimizations are by far not specific to that field. Being used by managers and engineers as well, they often constitute a common tool and language by which real option techniques and methodologies are spreading more easily from finance into other areas. Certainly, the technical dimensions of option evaluations is important and is part of the conceptual breakthrough that was rewarded by a Nobel Prize. But beyond techniques, the real option approach is mostly a way of thinking and adjusting one's behavior accordingly, which are as follows: recognitions that uncertainty creates opportunities and values. Other, recognition that such value requires adequate decision in order to materialize. Other, identification of sources of uncertainty and collection of information. Other, identification of the decision options that promote expositions to the favorable outcomes. Other, identification of the decisions that reduce exposure to downside risk. And finally, establishment of optimum decision rules. Real options and active management. Knowledge of real options empowers managers with the tool to calculate more accurate net present values (NPV) and thus make a better strategic business decisions. One can think of calculating the strategic NPV of a project defined as standard static NPV plus options premium from active management equal to strategic NPV. A real option approach helps executives quantify the value of active management. As standard, static NPV calculations typically are based on the discounted value of average outcome. The ability of executive to actively manage a project is not accounted for, and the static NPV will typically underestimate the true NPA of a project. Active management limits the downside and enhance the upside of the distribution of the NPV outcomes and can possibly change the expected NPV from negative to positive as the graph below illustrates. The upshot is that is the traditional statics NPV approach is taken, then truly profitable projects are not implemented, causing shareholder value of the firm to be less than optimal. Project evaluation and real options. A project evaluation is the most obvious application of the real option approach, although by no means the only or the major one. Before the real options approach, the standard valuation procedures was discounted net present value. The real option approach is best seen as an improvement to conventional discounted net present value determination. It does not invalidate the procedure but amends the way it is applied. In fact, it rationalizes what many evaluators are already doing on intuitive grounds that are attach importance to the timing of decisions. Another is identify and evaluate downside risk and upside opportunities associated with the project. Identify, evaluate, and optimize future decisions that may affect expositions to downside or upside fluctuations. To sum up, optimally manage the creation and use of flexibility as a device to exploit uncertainty. Once these dimensions of the project are introduced, projects become proactive instruments that modify the way uncertainty affects result in the decision maker's favor. Proper evaluation of cost and benefit always was crucial in conventional net present value evaluation. In a real options approach, cost and benefits evaluation becomes more difficult. Option created by the project now enter as benefits. Option used up by the project enter as cost. In both cases, these options must be valued, and in most cases, such evaluation involves finding the optimal way to decide whether and when the option must be created or used up. The box entitled Evaluation of a Flexible Vacation Package illustrates the basic evaluation method of both financial and real options. Both standard textbooks put options evaluations and the vacation package example are overly simplistic. Their main weakness is perhaps that they consider situation where although valuation is an issue, the decision that confers its value to the option sell the stock, take the trip is obvious in each case. In most real situations, the decision whether and when to exercise the option is the outcome of a complex optimization process which maximizes the value of the option. However, simple these illustrations do demonstrate how the methodology developed for analyzing financial options can be applied to real world problems. In fact, the difference between choosing a flexible flights package and an interruptible power supply scheme is not great. Of course, both the financial and the real options valuations methodologies utilize substantially richer descriptions of the uncertainty and employ more realistic assumptions. In the rest of our discussions, we mention and sometimes analyze several cases when the real option have been or could be successfully applied to improve management decision making. All of those cases are substantially more complicated than the above example. The basic underlying objective remains to optimally manage the creation and use of flexibility as a device to exploit uncertainty. This involves the following steps. First, identification of the sources of uncertainty and collection of information. Second, identification of the relevant future decision. Third, construction of optimum decision rules. Evaluation of flexible vacation package. Your travel agents offers you two types of vacation packages to the destination of your choice, that is rigid and flexible. Under the rigid package, you have to specify exactly the dates of your vacations. Under the flexible package, you can go for any 7 consecutive days between May 1st and September 30. Means 1 month is given. Furthermore, the flexible package is 80% refundable. How much more would you pay for flexible package? To simplify the problem, imagine you know for sure you will be able to take a week off this summer, but you don't know whether it will be in July or August. Means you are taking only vacations for exams only. But if there are few workshops or programs arranged by college, you are unable to arrange vacations from your company. So for that, you should have to manage your seniors. You should have a best relationship with your seniors. You should have to create a best faith into your colleagues to take vacations or leave. from your company. It is also a best logic. You estimate that each month has an equal probability of being convenient. Assume further that a week's vacation to the destination is worth $10,000 more than your next best alternatives. A week at the cottage, since you don't know which month will be convenient. You toss a coin and you pick July for the rigid vacations. Here are the payoffs of the rigid package. July good $10,000 and August good $0. Can't use the rigid package at all. Means you can use in only July month as a rigid package because you have the confidence that your boss will allow you a vacation in July month and not in August because August month is peak point of your business. So your boss will not allow you. Okay. So you are confident about July month. Since both July and August have equal probability of being convenient, ignoring risk the maximum you would pay for the rigid package is $5,000 equal to half of $10,000 plus half of $0. Consider now the flexible package. It allow you to take your vacations anytime this summer. So the payoffs to the flexible package are July good $10,000 and August good $10,000. Okay, means you have to pay either in July or either in August. The amount is same $10,000. Either way, you take your vacation, so you would be willing to pay $10,000 for the flexible package. In this specific example, the value of flexibility is as big as the value of the package itself. This is not unrealistic high, flexible, fully refundable airline tickets with open dates may cost as much as 10 times a rigid non-refundable tickets with fixed dates. Strategic planning for real options. A good strategic plan is a plan that builds real options into the foreseeable future, medium and long of the firm and sets up and optimize the decision making process to fruitfully exploit those options. Again, real options should be recognized, built in and evaluated for each major step of every project. Alliances, acquisitions and mergers, spin-offs, technology developments and management, organizational restructuring, etc. The value of strategic planning itself is determined by the quality of the real options designed and embedded in the plan and by the quality of the evaluation procedure of those real options. It is the precise sense that the design and management of real options through the exploitation of uncertainty create value for the firm and that they represent the most important responsibilities of the manager in determining a strategic plan. Strategic planning is an exercise in managing flexibility. Plans should specify decision nodes, that is, future steps that may or may not be taken at dates that may be given but are mostly to be chosen optimally. Furthermore, preparing a strategic plan is not a passive exercise in anticipating the future. It is an exercise in shaping the future, or more precisely, an exercise in preparing the way in due time. The further will unfold to the decision makers' advantages. That is, managers are planting the seeds of future flexible by identifying the creating real options. This is again a key differences between real options and financial options. With real options, managers are creating the tools or using existing tools in highly creative ways. In the case of financial options, financial executives usually pick their tools in the sometimes highly exotic kit of available instruments. One important characteristic of real options in an oligopolistic environment is that they may have a negative value. As mentioned before, the value of real options derives from the active management of projects variations as uncertainty unfolds over time. However, the possibilities of modifying the planned course of a given project imply that commitment to develop and eventually complete the projects is relatively low. This lack of commitments may invite more aggressive behavior from competitors whose objective may be to driven the firm out of the projects or market, or more aggressive attacks from the opponents to the project. Active management means that some options should be closed while others are kept open. It is a major responsibility of high level managers to identify which options should be closed in favor of strong communications or commitment, and which options should be kept open in order to be more able to benefit from more and better information as time goes by. Components of VAR: confidence level 95%, 99%. Second, time horizon 1 day, 10 days, 1 month. Potential loss amount: computation of value at risk, a parametric variance covariance method. Assumption: asset returns are normally distributed. Linear relationship between returns and prices. Formula is given. Simple and wide used, not suitable for had tilde distributions. Historical simulation method: use actual historical returns, no assumptions about return distribution. Steps: collected historical returns, arrange losses in descending order, selects loss at the required confidence level. Easy to understand, past data may not predict future risk. The historical method is the simplest method for calculating value at risk. Market data for the last 250 days is taken to calculate the percentage change for each risk factors on each day. Each percentage change is the calculated with current market values to present 250 scenarios for future value. For each of the scenarios, the portfolio is valued using full non-linear pricing models. The third worst day selected is assumed to be 99% VAR, value at risk, where the number of variable of one day is I. M is the number of days from which historical data is taken. Use actual historical returns. No assumption about return distribution. Other parametric method is there. The parametric method is also known as the variance covariance method. It assumes a normal distribution in returns. Two factors are to be estimated, and expected returns and standard deviation. The parametric method is best suited to risk management problems where the distributions are known and reliably estimated. The method is unreliable when the sample size is very small. Steps: collect historical returns. Second, arrange losses in descending order. Third, select loss at the required confidence level. Easy to understand. Past data may not predict future risk. Next, Monte Carlo simulation method generates random price paths using statistical models. VAR calculated from simulated loss distributions. Most flexible, computationally complex. Under the Monte Carlo method, value at risk is calculated by randomly creating a number of scenarios for future rates using non-linear pricing models to estimate the changes in value for each scenarios and then calculating for VR according to the worst losses. The Monte Carlo method is suitable for a great range of risk measurement problems, especially when dealing with complicated factors. It assumes that there is a known probability distribution for risk factors. Limitation of VR does not measure losses beyond VR, sensitive to assumptions and data, ineffective during extreme market conditions. Portfolio risk more than one assets concept. Portfolio risk is influenced by individual asset risk and correlation between asset returns. Diversification reduces risk when asset returns are not perfectly positively correlated. Portfolio risk calculations to assets formula is given. Portfolio risk with multiple assets general formula is given. Portfolio VAR. Portfolio VR is less than sum of individual VRs. Reduction due to diversification effect. Importance of managers. Assist in risk control and capital planning. Supporting regulatory compliance, Basel norms, enhance portfolio optimizations decisions. Today's our session is over. Thank you for all.